This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today is Marty Bergin. Marty is the president and owner of DUNN Capital. Yes, that would be the DUNN Capital that is featured in my book, Trend Following. Bill Dunn is chairman emeritus, and Marty took over the day-to-day operations of the firm in 2007 and became owner of the firm in 2015. I love to look at the track record of DUNN Capital. Their consistency, what they've been offering, has been very close to the same for over 40 years. There's not too many people out there that have a consistent track record at their level of performance for over 40 years. If you can't learn something from this conversation, and it's a no-nonsense conversation, I appreciate Marty bringing that to the table, but if you can't learn something, I think you're possibly brain dead. I hope you enjoy this conversation with Marty Bergin of DUNN Capital. Marty, as I was thinking about our call today, I was actually thinking, and I know you're a sports guy, I was thinking of the Patriots. I was thinking of the New England Patriots. And I know a little bit about how Belichick does things. And he's kind of this internal guy where, you know, his defensive and offensive coordinators kind of come up through the ranks. And I'm sure one day when Belichick decides to hang up the cleats, so to speak, I'm sure it'll be somebody that's been with him forever that will take over the Patriots. It got me kind of thinking about your situation, how you are now president and owner of DUNN Capital. Am I completely off base with thinking about Belichick and that kind of transition and how? Because, I mean, look, you've been with DUNN since, I think, 1997, and I'm sure you're going to correct me on the original date. The first time you met Bill Dunn, I'm sure, was years before that. So you've been with DUNN for a long time.
I like the analogy. I don't know that it's directly related.
He's football and you're trading, so.
Yeah, but it is kind of, you know, I kind of view business and sports and building teams and building a company kind of the same way as you would a sports organization. There's a lot of similarities, I believe. But you're right. I came to work here in 97, September 97. And before that, as you know, I was a CPA in a firm in Indiana, Virginia, which is the same area where Bill formed DUNN Capital and began trading before he moved down to Florida. The CPA firm that I went to work for, one of the founding partners of the firm was actually Bill's neighbor. That firm had been providing services to DUNN Capital and to Bill personally since the inception of the firm. So in the early 70s. And when I went to work there, the first job I worked on was going down and auditing DUNN Capital.
Your first job as a CPA was going down?
The first job at this firm. So I had spent 2 years at another firm in Reston, Virginia, and then went to this firm. Yeah, one of the first things I was asked to do was go down and work on the team that audited the funds at DUNN Capital.
You've got to give me some time back to that first moment and maybe talk about the first time meeting Bill and the first time where you really started to wrap your arms around what DUNN Capital was doing as a business.
I don't know how well your audience knows Bill, but Bill can be a very formidable and intimidating individual. I mean, I
remember my first time meeting him.
And when he shakes your hand, he will bring you to your knees. I mean, he has big, bare hands and a grip like a vice grip. I am the lowest level person on this audit, and there's a couple other players there that are higher up in the ranks. I'm new to the firm, and there was a certain procedure that had to be done with the audit that required somebody to sit down with Bill and discuss it with him. And the other two individuals on the audit didn't particularly want to go in and approach Bill and sit down and take his time on something that Bill would consider very frivolous. I got tasked to do it. That was my first meeting with Bill. I walked into his office, not ever meeting him before, introduced myself and said I needed to go over this questionnaire with him. And it was quite intimidating, but it was a good experience, and I'll never forget it. I think Bill appreciated it because I went through, I asked him all the questions. I didn't act intimidated, although I was, made it through. And that was the first meeting. I worked on that audit for 7 years, I believe. And then once I became a partner in the CPA firm, Bill approached me personally, saying that, his understanding was if he wanted to hire somebody from our firm, that he needed to clear it with me as the partner on the job. And I told him that wasn't necessary, but that it would be a great honor for our firm if he wanted to hire one of our people, at which time he said he'd like to hire me. At which time I responded that I had a really good thing going, and I wasn't sure that that was something I wanted to give up at this point. Which his response back to me was, well, that's okay. I'm not really sure you can even handle it. But why don't you come down and we'll talk about it? So I came down to Florida, and it took me about 3 seconds to say yes. And the rest is history.
Going back to that early time when you first went down there for the audits, I assume like everyone at some point in time, you were unaware of what Bill's business was. You were unaware. You learned quickly he was running a fund, but then you also had to have that light bulb moment of like the type of strategy he was employing. Can you speak for the audience out there, some of that feeling that you had, or those light bulb moments that were going off? Because even to this day, I would still argue with trillions of dollars out there in passive index funds, there's still, with you and your peers, there's still relatively few people, even it's a very smart way to trade, but there's relatively few people still employing the methods you do. Speak to that early on kind of aha moment for yourself when you wrapped your arms around what Bill was doing.
First off, you got to understand how I operate, because I've always been interested in numbers and finance and investing and that type of thing. I think the reason I became an accountant was because it was easy. I mean, numbers were natural to me, and this was just the easiest way to get through college and get a job and get paid. And I had invested some on my own and learned all those hard lessons about what you think you know that you really don't know, and that there's always people smarter than you out there. And I lost enough money to learn those lessons. At least they weren't devastating. So I was young, and there wasn't that much money to invest, so there wasn't that much to lose. Now, what struck me about DUNN Capital, because you're right, the first time I came down, I had no idea what they did. I didn't even know what the company was. I just showed up. But our firm audited a number of CTAs and managed futures. So as a firm, we had an understanding, and once, I finished the field work and got more involved, I got a good understanding of what CTAs do, about trend following as a strategy, the systematic nature of it. The aha moment for me with Bill was how client-centric his focus was. And I mean, this isn't just like a marketing ploy that Bill used to raise money. I mean, his belief from the beginning when he founded the firm was, hey, I want this to be a win-win situation. I want to be on the same side of the table as the investor. His first investors were all friends, family, and fellow employees at the government who put all their money together and said, here, Bill, we believe in what you designed. Go trade it with our money. And that's what he did. So he's always never charged a management fee, and he's always charged an incentive fee. So in other words, you make money, he makes money. Or if our clients make money, we get a share of it. And we always reset the high water mark. It's not... I find this interesting because there's hedge funds, a lot of equity hedge funds, where they reset it every year. You lost money all year long and you're down 20%. January rolls around and you make 2%, and all of a sudden you're paying a fee And you ask the guy, what happened to the 20% I lost last year? And they go, oh, we reset it every year. We start over. Oh, that's kind of convenient. So I think the aha moment was just the way Bill's philosophy about investing and taking care of people. And he's the same way with his employees. It's like being part of a partnership where you don't have the responsibilities of being a partner, because everybody shares in the wealth when we do well. Those were the things that attracted me to Bill.
You know, a lot of people know via my work that I'm a fan, and I think for one of the reasons you just stated, because I don't know, perhaps there is somebody else out there, but are there other? And I'm not saying this like, I'm a homer or something like that, but the zero is 0 and 25, is it?
Yep. If they have enough money, it's 0 and 20, anything over $100 million.
Do other firms do this?
Yeah, there are a few.
A few.
There's a firm in Charlottesville that is, I think they're 0 and 30. Their strategy is different than ours. It's more of a short-term strategy, but they've done similar type things and done well.
Is there an element when he originally set that in motion beyond just a good ethical principle? There must have been a certain belief too, strategy-wise, where he said, you know what, I'm going to do really well this way. The extra benefit is also that, clients are going to do really well. And so let's just, was there a strategy thinking, or was it just purely an ethical type vision of his?
Since I wasn't around when the decision was made over 40 years ago, I can't really speak to what was going on in his mind. We've never discussed it.
I like asking questions that the current owner of DUNN Capital does not know the answer to. So that's that.
Especially when it's about DUNN Capital.
Yeah. Well, look, it's like you said, 40 years ago. And let's talk to that for a moment, because I think that's a great jumping off point to get into a little more detail. 40 plus years. There's people out there to this day, and you'll see the press clippings that will come out, and usually it's probably some junior reporter that was assigned to cover managed futures and trend following or whatnot, and maybe they'll pick a certain 1 month slice of 1 year to write the next obituary or the heaping of praise. But 40 plus years, gosh, with the type of performance that DUNN Capital has generated over those 4+ decades, Warren Buffett and who else?
I don't know. There's not too many of us that have been around this long. And I think the other thing that's special about us is the track record that we publish is over 30 years long. You've seen all the bad things that can happen pretty much in that 30 years. There's firms that have been around as long as us, but most of them, if they have a bad moment sometime in their history, they kind of reinvent themselves. It's like a different system is rolled out. So the bad events of the past kind of go away because they have a new track record. So I wonder how many firms have actually, their primary product has a track record that's over 30 years old.
Look, and it's one of the great, even if we weren't just talking about you and the firm right now, for people that want to learn, for example, what Marty Bergin does at DUNN Capital, the WMA monthly performance, to look at it from 84 to 2016, to look at every month, in many ways, it's a PhD right there, just to look at your month by month performance. Like, as you said, it's really everything that has happened is embedded in that track record.
That's exactly right. And when you're looking at most track records, even a 10-year track record, let's think about it. If it happens to be a 10-year period where trend following is done well and you see no bad events, your belief is that will go on forever. That's always how it'll be. And that's not necessarily true. It's good to see a manager who has weathered the storm and rose from the ashes, per se, or has proven that the strategy has longevity, and it's just not a process of data mining the history and creating, the perfect trading model that may or may not work going forward, because nobody knows the future. And these pundits that sit on TV or write articles and talk about things that will happen, they're lying. They don't know what's going to happen. Nobody knows what's going to happen. You have to make an educated guess about who you're going to invest with and who you're going to trust with your money going forward. I think the fact that we have such a long track record, the fact that we've, invested a lot in research, especially in the last 10 years, to make the system better and take the things that we learn over the years and try to, technology today is amazing compared to when Bill started. Bill started, he was using punch cards in his basement and going to the local library and renting time on a mainframe to run his system. I mean, imagine that to what we have today, where you have instantaneous data, instantaneous feedback, instantaneous risk monitoring. I mean, things we can do today or that are available to us, and to not utilize those things to make your system better is just ludicrous. We embrace these things and are constantly working to try to improve what we do. With the idea that you see our track record, my belief is what you see will only improve over time. The market environment dictates the most, though, right?
Sure.
I mean, either you're in a good trendy market or you're not. Anybody makes money in a good trendy market. It's how you handle the rough markets that makes the difference.
Mark, there's a meme that I've been hearing, a kind of a statement about DUNN Capital style performance, trend following style performance, going back to '08. So for those folks that have memories, 2008 was a fantastic year for your style of trading. October of '08, a fantastic month. Ben Stein, the movie star and pundit, famously said that if you made money in October of '08, you were doing something wrong. So yeah, I know that you get a laugh out of that one. But the thing is that there's been this ongoing dialogue that I've seen in a lot of places, and a lot of people want to keep repeating it, saying that since '08, that your style of trading has been not good. And I'm looking at your 2009, 10, 11, 12, 13, 14, 15, 16. I'm looking at you were down small money, 5% for 16. You had a down month for, was it 2012? Down year for 2012. But other than that, that's not... What am I missing here? Everyone keeps talking about performance being really negative since 2008. Your track record doesn't reflect that.
Right. Well, it's because we're doing something different. And, I can't speak to what that is because I don't know enough about what other managers are doing in our space. But I will tell you this, it's not been an easy environment. Central banks have basically been controlling the economy since the credit crisis. And it makes for a difficult environment for any systematic trend following type strategy, I believe. I think what you've seen during this period of time is volatility strategies have done remarkably well. Because, the central banks kind of have caressed the markets and are holding them into a certain range or pattern. So volatility has been a wonderful trade, but trend following and a lot of systematic managers have really struggled. Short-term guys have done well and then not done well. Trend following has done well and not done well. And at the end of the day, they're all about flat for this period. And we've done fairly well. One is we've developed this, what we call an ARP, where we no longer target exactly the same risk parameters every single day. We have this proprietary way of measuring the market environment and sizing our positions depending on what the market is telling us that there's opportunities or not. So if we don't see a trending market, we tend to draw back the amount of risk we apply to the markets. And then when the markets start to trend again, we accelerate the risk that our system takes. And over the years, what it does is it decreases our overall volatility without decreasing our upside performance. So that's like the holy grail, right? People say DUNN is too volatile, too risky. I love their returns, but I can't really live with the drawdown. That's a fair statement, and we're not for everybody. But what if we could reduce the drawdown by 25%, reduce the volatility by 25%, and still have the same type of performance? Now people say, hey, wait a minute, that really interests me. And basically all you're doing is increasing the risk-adjusted return. So there's very large managers, and you would know who I'm talking about, and probably most of your listeners know who I'm talking about, that have great historical track records. And at one time they traded to a volatility of, 25 or more, maybe 30% in an annual basis. And over the years, they've slowly, or not even slowly, but they've decreased their volatility to maintain assets. They become asset gatherers because they're so large, and the management fee becomes very, very meaningful to them, much more meaningful than the performance fee. So they can decrease their volatility, thereby removing the risk of outsized losses and drawdowns, and thereby assets tend to stay. They become very sticky. But the expected performance has also been greatly reduced. But they have a track record that shows really good performance historically. And people have to understand that they're not going to see those numbers. That track record really has to be adjusted for the volatility that they've adjusted to. And what I'm trying to do is do the same thing without having to adjust my track record for the volatility. This went into effect in January 2013, and we had 3 outstanding years, especially compared to our peers. 34%, 35%, almost 11%, when I would predict that everybody was flat, slightly down over that 3-year period. And that's after the fees.
Even though you've made, as you just mentioned, changes in how you guys deal with volatility, your risk-adjusted changes, there's still, going back to the foundation, there's a philosophy, there's a commitment there with your trading strategy that's probably always going to be different. And I look at some of the larger traders today, and obviously you're spot on. Nobody can argue with what you just said about other track records. I admire some of that early performance, but you're right. There's a certain point in time where everyone says, or not everyone, but a lot of people say, hey, wow, this management fee business is pretty cool. But, for the purists out there and for the folks that still say, well, we can reduce our risk all day long, but we still want to make some money too. And I think your statements are spot on. And I think it's, foundationally, Bill set something in motion that is quite different to this day. And I think there's less and less people that are willing to go for the higher returns. And even though you say, hey, listen, today we still want the higher returns, we just want to reduce the risk some. But speak to that philosophy that has been set in motion for a long time. I think it's I always tell people that you guys are just a great operation to look at, even if they had no interest in making an investment. Just look at what those guys do, because I say it's almost like a class to study you guys, to study what you, no, it's true, to study what you do, because there's not many people doing it these days, because they've all kind of evolved to give the client what the client thinks he or she wants. And that's often something that is what you just described, which is a management fee product.
Right. Think about what's behind that decision. Over 20% of what we manage, which used to be a lot larger percentage, but as we've grown in assets, most of the assets are coming from outside. But over 20% of the money we manage is our own money. And the system that we're offering to the public here is exactly the same thing we're trading for ourselves. Our money is right there beside their money. Our positions are being put on at the exact same time their positions are. We share in everything. Everybody gets the same allocation of prices. We're really trading this for ourselves. We make a significant amount of money on our own trading, because we're one of the investors. We're right along with everybody else. So think about it. We make 30% on our money, plus then we're collecting a fee from our investors. And the fact that we have so much money in here, it allows us to cover our overhead during times when things aren't going well. We can sit here and criticize people that charge management fees, but think about the overhead of some of these huge trend followers. When they have 100 PhDs on staff and then all the associated administrative people to service that, how do you do it without having a guaranteed management fee, right? They've built themselves into this huge thing that has to be serviced. It's kind of like the financial industry as a whole. You think about investing. All the players that are involved, you got the brokers, you got the RIA, you got the bank, you got, the trading platforms, you got the exchanges. Every one of those things I just named, they all are guaranteed to make money. The way the system is designed, everybody makes money and takes no risk, except for one person in the equation. That's the investor. And the investor never takes risk. And, Bill's philosophy or Dunn's philosophy is, it's already loaded against them. Why should we pile on? I've never had an investor complain about paying me a fee. On the same
They're making
side,
money. They're making money when they pay you a fee.
That's exactly right. But they aren't happy when they're losing money. But it's a little bit, they feel better about it when they know I'm not making money when they're losing money. Yeah. So what could be the worst thing in the world is you lose, 20% in the year, and yet you paid the guy money to lose that money for you. That's a pretty tough pill to swallow.
Marty, let me take you on some topic areas to jump around a little bit. I think for people that already know, people that don't know, you guys are systematic, 100%. So there is, I've been down to your office a few times, but if I was to roll in today, there is not an army of traders with VR helmets on, staring at screens, punching away like they're playing a video game. There's a discretionary element is not part of your operation.
Right. We're not 100% systematic in the idea that, once we determine the trade, we use a computer algorithm to make the trade. I still do have traders that will use platform algorithms. They'll use, everything's traded electronically, but they will use a combination of methods to get the trade done. Basically, we calculate every day our new positions, and then our trading team is tasked with putting those trades in place before the next day.
So let me rephrase that. So for the brand new college student out there that wants to learn from Marty, or the institutional investor that might want to invest, there is nobody at your firm that is glued to CNBC, and if Kernan says something or somebody from Davos says something, that you guys are adjusting positions on the fly, in or out, adding to positions, or anything of the sort.
Nope. All emotion has been removed from the equation, which I found when doing my own investing, emotion is the problem. and there is quite a few times that I have seen a trade, when we run our system overnight and it comes up with the trades and we want to take a certain position, and I can look at that position and go, geez, perfect example. We got long bonds 2008. And for the whole time from 2008 to the end of 2016, I've been looking at that position going, this is crazy. How much higher can bonds go? Interest rates are basically zero. Why are we in this trade? It's probably the place we've made the most money from 2008 forward. And yet I've sat on panels in front of huge rooms of people telling and saying, this is years ago, who would have thought we would be long bonds? And everybody in the room shakes their head. And I say, I would have swore it's a terrible trade. That's where we're making money. And that's true. Now, we're not long bonds today.
That's not because there's no fixed income department. I mean, obviously, we're talking about systematic trend following strategies, but there's no fixed income department there with bond experts that are helping you to do that trade since '08.
No, it's all done purely on price data. It's a systematic system that we feed it the price data every day. It determines whether we're going to be long or short and by how much. We basically take a position between what we call +1 and -1, and it could be anywhere in the middle there. So, right now we have a slight short position on. That's what the system tells us to do. And then the other thing that I find interesting is you've seen a lot of pundits out there saying that, okay, CTAs have only made money because bonds have been in a 30-year bull market. So all it is the carry interest on bonds. All right, that's a fair argument. So what's going to happen when bonds are in a bear market for 30 years and interest rates are going up for the next 10, 20, 30 years? We're one of the few CTAs that have actually lived through some of the bear market in bonds, and we've made money in those markets. And what people forget is they think that, it's a carry interest, but all that we're looking at is the price of the bond. The carry interest is already in the futures price. The futures price is nothing more than a bet that says 3 months later, I think interest rates are going to be here. Now, they're either going to be higher or lower than what people think. And if you're on the short end, you sell it. And if interest rates are higher than people thought, then you make money. And vice versa. It's very simple. So just because interest rates are going up doesn't mean we're going to be short bonds, because maybe interest rates don't go up as fast as people think they would be or should, and then you're going to make money on the long side. We can make money whether it's rising interest rates or falling interest rates. Even in the interest rate markets, we'll make money.
How many guys, gals, men, women that get out of, and I'm not saying this to try and be all that or anything like that, or try and make it seem like we're having this great conversation, but how many folks today getting out their Harvard MBA, the Wharton MBA, truly wrap their arms around what you're describing? I mean, it's just, to me, it's still just such, not only is it a very successful business, a great way to make money, a great way to have a client business, it's just a cool damn concept too.
Yeah. Well, people overthink things, especially in the financial industry. I mean, people have learned how to dissect the marketplace and how to, calculate roll yield and calculate these things, and they start overthinking the process. Whereas you have to get out of the forest and look at the forest and get out of the trees and say, oh, wait a minute. All I'm doing is betting on the delivery date, what the price is going to be on this date. And do I think it's going to be higher or lower? And, we apply techniques to the data that predict whether it's going to be higher or lower. And it's just that simple.
Well, if you make a mistake, if you're losing money, that tells you something.
Right. If you're wrong, so what? The system says, okay, now you rather be short than long, or vice versa. And think about that. If you pick a stock, I mean, we've all done it in our own portfolios where we pick a stock and we're in love with that stock and it just keeps losing money or doing nothing. And, you never want to give it up because you have to admit you're wrong, right? And that's a hard thing for a lot of people to do. Well, the system doesn't have any problem admitting it's wrong. It's not admitting it's wrong. It's just saying, hey, today it's better to be this way. It's better to be long. Yesterday it was better to be short.
Marty, let's talk about another benefit here that comes from the return stream that DUNN Capital generates. Talk about correlation, because I mean, look, everyone still to this day is fixated on what the Dow and the S&P is doing. Look, and people are always going to have some type of allocation there. But when you take a return stream from something from a DUNN Capital and add it to some of these typical indexes, some magic happens, doesn't it?
Well, right. I mean, that's why people invest in managed futures, is for the non-correlated revenue stream. So, for instance, 2008 when we clearly did something wrong and made 50%. You're glad that you had that wrong investment in 2008. It's insurance against your portfolio in general. So think about going into 2008. Hedge funds were huge. I mean, if you remember right, there were retail investors were investing in hedge funds. Everybody wanted to have a hedge fund. The problem was when 2008 happened, all of those quote-unquote alternative investments in hedge funds all became very correlated, and everybody got crushed. And basically, the only strategy that stood out during that time was managed futures, and I suspect it's because managed futures can get short just as easily as it can long. It doesn't cost any additional funds to be short a position. And secondly, it's a much more diverse portfolio, because you're not just betting on stocks going up and down. You're looking at bonds and whether they go up and down, and currencies and whether they go up and down, and energies. And for our portfolio, even the commodities, the softs, the metals, the grains, all of these things create diversity. You know, we're diverse over markets. We trade so many different things that are uncorrelated. We're diverse geographical areas because we trade throughout the whole world. And then the strategy on its own is also uncorrelated to almost any other investment strategy. You know, there's a slight correlation to bonds, but so small that it doesn't matter. There's no correlation to equities whatsoever. And what I need to clarify for people, they kind of get the idea that no correlation means opposite correlated. No. It doesn't mean that every time stocks go up, we go down, and vice versa. What I can tell you historically is when there have been black swan events in equities, managed futures have done well. There's this non-correlation that occurs throughout the marketplace over time, but a opposite correlation comes into play during bad events, which is where, you know, this strategy kicks in as an insurance policy against your portfolio.
What you're saying there too is that, for example, if the audience sees the S&P goes up 25% in 1 year, that's not, you could go up 30% that year too and still have zero correlation.
Right. And that's what I call the cost of insurance, right? It's great to invest in something that makes money when S&P and equities goes down. The problem is you don't want that thing to be losing money when they're going up. I mean, look at the last 5 years and the market has just steadily climbed. You would be pretty upset if your investment, you know, in managed futures was losing money, which there's a lot of people out there that has been the experience. What I'm hoping that our system does, and it has proven historically to do, that even during the good times, we can still, you know, keep pace or outperform the S&P. I mean, historically, we've outperformed the S&P sizably. And that's important.
More than sizably. It's like one of the most amazing charts in finance. I mean, frankly, really. I mean, I don't know. I don't have it in front of me, but that one that goes back to the early 70s from inception, and then comparing to the S&P. That's just one of the most interesting. I mean, I would think you put that chart on the table, and whether it's a class or a potential investor, everyone just looks at that chart and goes, where did that come from?
I mean, this is what I try, this is the education process that I'm trying to do with people, is for them to understand that, this insurance, this type of strategy is something that everybody should be participating in. Even mom and pop retail people should have exposure to this type of strategy, which is beginning to happen because you have 40 Act funds that are now offering not only our strategy, but other strategies. It's a shame that this whole idea that you have to have money to avail yourself to strategies like this that can help you make money over time, it just doesn't make any sense to me. But that's another subject.
Well, it's something I actually wanted to bring up with you, because that is a fairly significant change, I guess, for DUNN over the years, that transition to where the way that investors can participate, that's changed. And as you just mentioned, I mean, mutual fund options, I don't know how new that is for you guys, but it's something relatively new, isn't it?
Oh yeah, and the reason it didn't happen before is we couldn't find somebody that would partner with us that didn't want to be guaranteed some kind of fee. We had been approached by a number of mutual funds over the years that wanted to represent DUNN. The problem was they wanted DUNN to charge a management fee so that they could share in that fee and pay their bills. And we always said no. Now, we don't have a problem with a fund or a platform charging a fee to cover their cost. I mean, I'm not expecting people to give things away for free, but I expect it to be fair and reasonable. And so we finally were partnering with a group, Aero Funds, now out of the Baltimore area, right outside of D.C., who, approached us about taking over a fund that they had. They already had a managed futures fund in place that was already trading. They weren't happy with the performance and thought that we could do a better job for them. So we took that responsibility over. But it's a fund that has a very reasonable pricing structure. And as you know, in the mutual fund space today, I mean, you gotta be competitive. Because of that, it's opened the door for us to get more involved. So we've done that. We've got a 40 Act fund, and we also have a UCITS fund in Europe, which is open to, more or less retail investors.
I want to take it back to March of 2009. I think if anybody had to make a prediction as to where the S&P was going to go in March of 2009, very few people, I think, sealed a prediction in an envelope and opened it up today. And, this is where we are today. I don't think very few people predicted that. But on the flip side, given, you kind of hinted at this earlier and more than hinted, but given central bank policy, given rates at zero, you can't say there's a one-to-one connection, but I seriously doubt the S&P would be where it's at today if we had, 6% rates or something of that effect. Speak to the idea of, look, you're not a prediction guy. I'm not asking for that. But when you have a run like we've had and you have rates at the level they are today, it's too perfect. It seems like almost anything could break that chain and we could go in an entirely different direction. I guess what I'm saying is it's like, look, we've had two 50% S&P drawdowns in the last 16, 17 years. Why should I not imagine a third?
I mean, I can't even speak to that with any intelligence whatsoever, because I think there's a lot of people that have feelings similar to yours. They're uncomfortable with the run that's happened. Nobody has any basis for that thought process other than the fact that it's been good for so long and how can it continue? I mean, it's good for us because I'm seeing a lot of inflow of assets from people that are uncomfortable.
The S&P could double from here, though.
Right. I could argue exactly that. I mean, you look at the policies that are being talked about being put in place in the United States, this removing the government stranglehold and the regulation stranglehold on people and allowing businesses to go back into the free market and do what they do best. And trust me, business people, even when they're strangled, they figure out a way to make money. I mean, when there's a will, there's a way, and the ingenuity of people in this world is absolutely amazing. You can put people under the worst conditions in the world, and they'll figure out how to make money. I mean, you can go anywhere in the world, and you're much more of a world traveler than I am, and I'm sure you've seen it. I mean, you see people on streets that have developed businesses out of their own homes to pay their daily needs. And, when you take the yoke off and allow people to do these things, heck, I could see the S&P doubling. I could argue that the S&P could collapse. I mean, you can make an argument for any theory you want.
And that brings us back to why you trade price.
Exactly. Everybody trades information, correct? And that's all it is. It's information people try to develop, create find information and make decisions on it. What has more information in it than price? It is the accumulation of all information in the marketplace is in that number. And that's all we trade.
I still think your style of trading is probably one of the absolute best representations that one can find for Kahneman and Tversky's work in prospect theory. I mean, behavioral finance for my money, is best represented in the type of trading strategies that you guys employ. It's like all those biases. You guys are kind of like saying, we know these biases exist, and we've built this strategy to keep us going in the right direction.
Right. And I think you could take the same approach with maybe some other type of strategies, like maybe looking at shorter time frames or doing some things that aren't quote unquote trend following. But what we found is the one thing that stands the test of time, since as far as you can take research back, there's been white papers that have been written that basically confirm the theory that trend following has always worked over time. Now, doesn't mean it's going to be the greatest strategy over a 12-month period, even over, 24, 36-month period. But over time, it's always going to make new highs. I mean, we made a new high in July of last year. And that's all you're doing is going from new high to new high to new high.
That's 40 plus years in.
Correct.
That's just so cool, right? I mean, it's listen, congratulations though, because I've known you for a long time, and I think it's a great story. And I do kind of like my Patriots example. I like, because I mean, look, there's other stories in finance about this, but in many ways, you and probably other people at the firm there, you guys have trained with Bill, learned from Bill, and now are leading the company, and you are, the leader. And I mean, that's a cool story, really.
Oh, yeah. And I think, from my perspective, Bill has been a mentor to me in so many different things, not just in business and in finance and trend following, but just in life in general. I mean, his views on libertarianism and free markets and capitalism, they've kind of just spread. I'm a true believer from seeing, what Bill has done and him opening my eyes to these things. And over the years, I mean, more and more people see the light. Not saying that everybody that works at DUNN views it the same way, because we're very diverse, and, all we're interested in is talent. We don't really care what people's belief is, as long as they're talented individuals. That's how I equate this to building a team, right? You always look for the best talent, the best quality people, the best individuals, and then you build them into a group, all with moving in the same direction, rowing together, as they say, same goal in mind. And that's what we've done. We have 22 really good people here. Any one of them being removed from the equation would make us a lesser team.
I can think back, and it's been a few years, but I can think back to some early experiences where I had a chance to be around Bill, and just brief instances, dinner, meetings, stuff like that. That happened in my probably my 30s, and those. And even though it was kind of from afar and not working with him or on a daily basis or anything like that you've gone down that path, but it was still influential. I mean, you just knew you were around somebody that was giving you confidence, not in a cocky way, but just kind of the way he was, and to hear him talk and to see what he was doing, it was kind of like, wow, that's just inspirational. That's how it's done. Now, plenty of people perhaps maybe saw him up close and didn't get it, but I remember just seeing him up close and going, okay, this is how it's done. You can make a bet. You can make a bet that this guy, you just knew he knew what was up, and then it was easy to pretty much verify what he was saying. And so, I mean, for me, it was a great learning experience.
Yeah, you would say that he gave you instant comfort, didn't he?
Yep. You just knew.
If you were an investor, you met Bill, within 2 minutes, you were like, I don't even really care what these guys do. I'm in. I mean, he's still our largest investor.
Well, listen, Marty, I won't keep you. Great conversation. Hopefully we can keep doing these. I always enjoy it. Again, congratulations. best of luck, and I can't wait to see what happens in the future, especially if that interest rate trade changes, because that's going to be the real interesting one to see unfold.
Well, thanks for having me, and keep up the good work. It's amazing how many people that I talk to in the industry that say that they either read your stuff or listen to your blogs or have read your books. That's a credit to you.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.